On May 18th, something historic happened. The market surged by a record-breaking 17% in a single day. Investors and fund managers were sitting on cash because they were convinced that a massive correction was coming. They were left in disbelief that day. Just one wrong call and they had missed a once-in-a-lifetime gain. This is a brutal reminder that even the professionals can't predict the market movement. So why do so many still try to outsmart, risking their long-term growth on short-term bets? In this video, we will reveal why timing the market without a proper formula is a trap and how to avoid such shocks and what the real winning strategy is to grow your wealth. And all this without gambling or predicting what is going to happen next in the market. So the question is, when Nifty climbs to 1 lakh, will you be there? Will you be there to reap the rewards? Today, let's say the market is at 24,000. That is more than 4 times growth waiting to happen when it reaches 1 lakh. To gain the real insight from this statement, we need to understand 4 key stories. One is about redistribution of wealth in bull markets. So in a bull market, everybody's wealth generally goes up, but actually not everybody benefits the same way. Because before this, the market has dipped and people in panic sell off their investments and they are sitting on the sideline hoping to buy back at a lower price. But the disciplined investors, they stay calm, they hold on, and some of them even keep buying at the lower prices. So now when the bull market starts to take off again, it is these disciplined investors who really see their gains in the portfolio. Essentially, the wealth from the panic sellers that they lost has now moved into those who stayed invested. So in the end, the wealth is redistributed to those who are patient, who do not predict the market, who continue to stay invested. So what is special about this 1 lakh mark? If you look at the history of the stock market, in 2002, Nifty was at 1,000. Today, in 2024, it's about 24,000. So in 22 years, it has multiplied 24 times. It means Nifty has approximately doubled every 5.5 years. That is a 13% annualized return. So here when you start, it's 1,000, then it doubles to 2,000 in 5.5 years. Then in another 5.5 years, it becomes 4,000, doubling to 8,000 in 16.5 years, 16,000 in 22 years, and 25,000 in 24th year. So at this rate, Nifty may touch 1 lakh in about 12 years or so. Well, nobody can say for sure, maybe sometime earlier or sometime later. But here's the key takeaway. It's not just about waiting for Nifty to hit that 1 lakh mark. It's about how you position yourself for that growth. Investors who sell frequently or are panicking during market corrections or dips, they lose out on these multi-year returns. This explains why staying invested, remaining invested, is the real winning strategy. Those who had the staying power, even during downturns, even through market crashes, they are the real winners, those who remained invested. So back to our first original story. What happened on 18th May 2009? The elections were over and the popular belief was that a coalition government is going to be in place, and that can cause a slowdown in the economy and the stock market. However, there was a huge surge in the stock market that happened when the election result came out, and it threw a surprise that many investors and fund managers were caught off guard because they had positioned themselves for a market crash. So they sold early, they were holding cash, waiting for a better entry point. So most of the funds underperformed that market that year. The best days in the market often comes when they are least expected. So if you sit on the sidelines, it means you're going to lose a substantial gain. So instead of getting swayed by fear, by bad market forecasts, focus on the long-term goals and stay committed to them for the long term. Look at this chart. Making money through equity investing is simple but it is not easy. The greatest things in life are achieved through simple actions, but they are not very easy. So the ease of access to investing today with the modern day apps, that coupled with the human emotional biases of fear and greed, makes investors prone to making a lot of errors in investing. So look at this data from US-based Russell Investments. The average stock holding period has kept reducing. The long-term investors in 1960 held on to stocks for 8 years on an average. That kept reducing. And in 2013, the holding period was only 4 months. In 2024, you can take a guess what this could be. Two ingredients needed for successful investing: the quality of investments that you make, emotional temperament and discipline. Most investors today are investing in those sectors and thematic funds which have delivered the highest last 1 year return or last few year returns. They are running behind returns, not necessarily behind fundamentals. But what most investors don't understand is that past performance does not guarantee future returns. There are some smart investors today who are investing in funds that are investing in stocks that have gone through a long period of consolidation, where the historical volatility are very low, where the past returns are very low. Lower volatility have much lesser drawdowns in a crashing market. If you would like to receive a detailed copy of this, please email me here. You can read it to appreciate concepts such as risk-adjusted return, preserving capital as a focus of investing, etc. If you had invested 100 rupees and it falls to 50 rupees in a crash, that's a 50% correction. But now you have to return back to the original capital, you will need a 100% gain. Smaller drawdown means smaller gains to return back to your initial capital. Hence, by falling lesser than the market, you are actually outperforming. You can have this as an investing strategy. The final story is about inflation. Doubling your money from these high bases of 24,000, you may doubt. You might say it's fine, it doubled and increased from 1,000 on the NIFTY. But from these very high levels of 24,000, can market still double? 1 lakh looks unsurmountable today, but half of it is just illusion. It is just inflation. Look at it the other way. If you do not invest in these inflation-beating assets, these assets that can beat inflation, the same amount of money will buy you less in future. So 1 lakh is just a number. It is just the representation of a potential. As they say, like age, NIFTY or index also moves only forward. So it is not the market that is growing. It is your purchasing power that's being preserved and expanded through these wise investments in equity. The last story is about a concept called old money, an aspect of investing that is normally overlooked. This is about generational impact that your portfolios can have when you stay invested through market cycles. You're not only building wealth for yourself, but you're laying the foundation for the next generation. Think about families that have passed down the wealth through disciplined long-term investing. They did not just profit from one single market cycle. They benefited from multiple market cycles, allowing each generation to start from a higher baseline rather than resetting from the previous one. When you jump in and jump out of the market, you're resetting the wealth building potential every time. But those who stay invested through the ups and downs are taking advantage of compounding over many decades. They are creating wealth that can outlast their own lifetimes. So think of equity investing as creating family legacy that is beyond these temporary corrections. So it is not about whether Nifty will hit 1 lakh or 2 lakh. It is actually about setting up your family to be there beyond this. That wealth that can impact those who come after you. So if you like this content, please do share it with your friends, your family. Please consider liking this video and subscribing to this channel.